The general view on banks. Let's get our next guest's opinion on that sector and the outlook for the markets. Lesley Marks joining us, Chief Investment Officer at Mackenzie Investments. Lesley, great to see you.
Good morning, John.
We're nearly through bank earnings season here in Canada. Are there any big takeaways from what you've heard from the big players so far?
Well, I think that they're a really good indication or a leading indicator for the Canadian economy. So what I've been looking across the banks is to see those little tidbits or nuggets about the Canadian economy that are really going to help us think about how the Bank of Canada is going to view the economy. I mean, we think of macroeconomic data as the thing that central bankers look at, but they're also looking at what companies are saying and the view from corporations. And so what we've seen across the banks, it's been generally mixed results, but I think the expectations were quite low. Of course, we had National today, and you were talking about the weakness, the prevalence of weakness in the capital markets trading business. We've really seen that across the board. It has been a weak capital markets environment this year, really on the back of the weakness on equity markets last year. The new issuance business has been very weak across the banks.
Yeah.
But wealth management's been an area where markets have improved, and so wealth management earnings have come up a little bit. But you talked about the provisions for credit losses,
right.
PCLs, and that's something that people have been watching very closely. And I would say the good news is we didn't see any major surprises on PCLs. One negative that I've picked up across the banks has been expenses. Banks have really been expanding their expenses through the pandemic years. And now that business has slowed, they're starting to roll back expenses. And we've seen efficiency ratios decline. And so we want to see greater efficiency from the banks. And they're a very large employer in this country.
Yeah.
So hearing about cutting workforce, in that 2.5% range, that's a material number for the outlook for the Canadian economy.
Well, I do want to talk more about the economy, and you're right. I mean, if people don't have jobs, that obviously is one of the considerations for how robust an economy can be. But I guess this storyline of cost cutting in sectors where you've seen it quite prominently, in some cases, investors have been rewarded or have rewarded companies for that action. And banks in general are one of those sectors because some of the lingering uncertainty that have lagged. Certainly they've lagged, let's say, technology so far this year. How do you feel about investing in that sector if so many of our audience members who like to bet on the banks longer term?
The Canadian banks are a very high-quality investment, and structurally, it's a very attractive market to invest in because of the concentration and the quality of our Canadian banks here. So, you don't want to bet against the banks over the long term. I just think that the short term here, and they're priced inexpensively right now. So I think that they are reflecting a lot of bad news. But to see a turn in earnings momentum here, I think we need to see two things happen. One, I think we need to see greater conviction and optimism around the future for markets. And I don't think that exists today. And because that will really get things going on the capital market side. And there's a lot of earnings leverage there. And I think the second thing that needs to happen with the banks is I think they, this is a general statement, but in most cases, they really need to get their costs in line with the current outlook, which really has deteriorated from, say, 3 years ago. Similar to technology, again, during that pandemic area, financial services and technology did very well, and they really grew their employee base and expenses on the back of that. So now I think there needs to be greater prudence around that expense growth, and I think we're going to see it. The banks have been very good over time at adjusting their expenses in line with revenue growth, but there's obviously a lagged effect to that. So don't count the banks out as an investment for Canadians, but I do think that the short term, we still could see some continued headwinds. It's a little bit early.
It's interesting. This leads us into a broader question about the markets and the economy. So you'd seen more so in the U.S. A strong run for the first half of this year because investors were moving back into a lot of those technology stocks. August has been a tricky month. We could debate all the reasons why, but it's interesting looking at yesterday's trading action where you had some signs of U.S. economic softness. Even this morning, we've already talked a little bit about more signs of softness and the U.S. economy expanding at a slower rate than what was previously thought in the second quarter. And then people look at that as a sign that perhaps central banks like the U.S. Fed can't stay as hawkish as they've been. And just to kind of put some of the puzzle pieces together here, that narrative has been within the belly of the markets for some time now. But every time we hear from these central bank leaders like Jay Powell, we heard from him recently, and sort of this commitment to higher interest rates, everybody gets a little bit uncertain about what that means for the markets. By comparison, every time you've got soft economic data that crosses, people, it feels like to a certain extent, in the markets cheer that news and then bid up stocks again. What's been your view of that phenomenon? Well,
I loved your metaphor about puzzle pieces, because that's exactly what it is. You know, we're bringing in little pieces of information here. But I do think that, you know, what we saw yesterday, and this is, I think, a big change, is bad news, economic bad news, was really good news for the markets.
More definitively than we've seen in a while,
and people are really holding on to that because, as you said, the economic data has been mixed. But I think it's interesting, you talked about you know, Powell's commitment to higher interest rates. Powell's commitment is really to fighting inflation, and interest rates being the vehicle to do that. And I think what we are starting to see, and we saw it here in Canada first before the U.S., is, you know, I saw a headline yesterday around people are starting to wake up to higher interest rates. And I think that's exactly the case. The consumer has moved decidedly more negative in their outlook. Consumer confidence is certainly waning here in Canada. And we saw many companies talk about that in their Q2 earnings discussions around a marked change over the second quarter. Now we're starting to see that come out in the U.S., and that consumer confidence number, I think, yesterday was so important as an indicator for that. And then the jobs opening data also kind of built on that. But consumer confidence is something that very much we'd be looking at as a leading indicator, as would central bankers. And so in that puzzle of bringing the pieces together, I actually think that this is very material data and really makes us think that both the Bank of Canada and the Fed might be close to the end here of this hiking cycle.
Well, it's been incredible to speak to experts this year because I get it all. I get people who say, don't worry too much, we're going to get through it and stay invested in the market in a big way. I've got others who are predicting a very uncertain economic road ahead. How are you positioning right now at the end of the day based on what we know right now?
Well, I think you talked about it being, you know, really, it's been a very tricky year because I think the experts, in general, I'm generalizing here, got it right. Most people thought that interest rates would be higher for longer, and that the last mile to fight inflation would be more difficult. And so what we saw was in October, people were expecting, interest rates were going to start to fall, and we had this big run in technology stocks. Well, what happened was we had this continued run in technology stocks, but interest rates didn't fall. So we got the thesis right. I think the impact or the outcome was unexpected for how equity markets would move this year. So that's been the big surprise. And so I think positioning from here, I think all of those conditions still exist, that interest rates are biting. They will remain higher for longer. It doesn't mean that it's not right that they'll start to come down, but the economy is starting to show more apparent cracks right now. And I think for equities or riskier assets, that's a bigger headwind. And so that brings us back to that bonds versus equity positioning. And I think that the outlook right here is still headwinds for equities and more optimism here for fixed income investing, either in the Treasury or the government side or in high quality corporate credit.
All right.